The distinction between currency and money is one of the most crucial concepts in economics and personal finance, yet it is often misunderstood or overlooked. To fully grasp this difference, we need to explore the characteristics, roles, and implications of each. Currency is essentially a tool designed to facilitate transactions. It is a medium of exchange, a unit of account, and must meet specific criteria: portability, durability, divisibility, and fungibility. These qualities ensure that currency can be easily carried, withstand wear and tear, broken into smaller units, and exchanged interchangeably without losing value. For instance, if you borrow a $20 bill, it doesn't matter if you repay the lender with a different $20 bill or smaller denominations, such as a $10 bill, a $5 bill, and 5 $1 bills. This interchangeability is what makes currency fungible. However, true money goes beyond these basic attributes. Money incorporates all the qualities of currency, but also includes a critical additional function. It serves as a store of value. This means money can hold its purchasing power over time, allowing it to be saved and retrieved later with its value intact. If the cost of a good doubles within a year, what you're using is not money but currency because its purchasing power has eroded. Currency, by design, is not intended to maintain value indefinitely. Its value is subject to inflationary pressures, government manipulation, and other economic factors. Unless we experience an unusual deflationary period, which is rare and short-lived, currency consistently loses purchasing power over time. True money, often referred to as honest money, retains its value over the long term. Historically, gold and silver have fulfilled this role, standing the test of time as reliable stores of value. These precious metals have been used as mediums of exchange for over 5,000 years, providing stability and resilience unmatched by fiat currencies. An example of this enduring value is a silver coin from 500 BCE. Despite its age, the silver content within the coin retains purchasing power today. Gold and silver prices may fluctuate based on market conditions and investor sentiment, but their value never drops to zero, unlike paper currencies, which can become worthless through hyperinflation or economic collapse. The resilience of gold and silver lies in their intrinsic value. These metals are rare, require significant effort to extract, and cannot be easily reproduced. A gold coin, for example, is the result of a labor-intensive process that begins with prospecting, continues with mining and refining, and ends with minting. This physical labor and resource allocation imbue the coin with tangible value. When you trade such a coin for goods or services, the transaction reflects a fair exchange of equivalent effort and resources. In contrast, fiat currencies, paper money issued by governments, are created with little effort. Banks simply imagine them into existence through mechanisms like fractional reserve lending or quantitative easing. This process dilutes the existing supply of currency, reducing its purchasing power and effectively transferring wealth from currency holders to the creators of new currency. This is not only inefficient, but also inherently unfair, as it constitutes a subtle form of theft. When fiat currency is used to acquire real assets, such as a house, without an equivalent exchange of value or labor, the transaction becomes fraudulent. For example, when a bank creates money out of thin air to fund a mortgage, the currency used to purchase the house is not backed by real effort or resources. This artificial creation of wealth undermines the principles of fair trade that honest money upholds. One of the most striking examples of the difference between currency and money is the apparent rise in asset prices over time. Many people point to rising home prices as a sign of increasing wealth, but this is an illusion created by inflation. If a house doubles in price over a decade, its value may not have changed at all when measured against other real assets. For instance, If the cost of groceries and gasoline also quadruples during the same period, the house's purchasing power relative to these necessities has actually declined. Similarly, if the stock market outpaces the rise in home prices, the house has lost value in terms of the stocks it could purchase. These examples illustrate the critical distinction between nominal price, what something costs in currency, and real value, what it can buy. This principle becomes even clearer when examining long-term trends. Historical data from the 1800s reveals that no asset class experiences permanent appreciation in real terms. Gold, silver, oil, stocks, and real estate all move in cyclical patterns of overvaluation and undervaluation. While prices may appear to rise steadily due to inflation, the actual value of these assets fluctuates relative to one another. For example, during the Great Depression, the average price of a single-family home was a few $1,000s. Today, the same home might cost hundreds of thousands, but the number of hours of labor required to afford it has not increased proportionally. This disparity highlights the role of currency devaluation in creating the illusion of rising prices. Gold and silver are uniquely positioned to navigate these cyclical trends. During times of economic stability, these metals may seem less attractive compared to higher-yielding investments like stocks or real estate. However, in times of crisis, when fiat currencies lose value rapidly, the demand for tangible assets like gold and silver soars. This was evident during the bull market of the 1970s, when gold's price rose 25 times and silver's price increased 41 times within 8.5 years. These gains were unprecedented, making gold and silver the ultimate safe havens during periods of economic uncertainty. The current economic environment suggests that we are on the brink of another major shift. Since the early 2000s, gold and silver have been in a secular bull market marked by a prolonged rise in value. Although there was a significant correction after 2011, this mid-cycle lull is consistent with historical patterns. The magnitude and duration of the current bull market exceed those of the 1970s, indicating that we may be approaching another period of explosive growth in precious metals. This shift is likely to be driven by mounting economic imbalances, including unsustainable debt levels, inflated asset prices, and declining confidence in fiat currencies. Market manipulation by central banks and governments has created an illusion of stability, but this cannot last indefinitely. Policies such as quantitative easing and artificially low interest rates have distorted asset prices and fueled speculative bubbles. When these bubbles burst, as they inevitably will, the demand for honest money, gold and silver, will surge. Investors who have held onto these metals during the correction period stand to reap significant rewards as the market corrects these distortions. The importance of understanding the difference between currency and money cannot be overstated. Currency is a tool for facilitating transactions, but it is not a reliable store of value. Money, on the other hand, preserves wealth over time and serves as a foundation for fair and honest trade. In a world where fiat currencies are increasingly manipulated and devalued, gold and silver remain beacons of stability and integrity. For those who seek to protect their wealth and navigate the inevitable economic shifts ahead, investing in honest money is not just a prudent choice, it is an essential strategy for long-term financial security.